So today we're going to finish the chapter 2 handout, and we're going to start chapter 3 handout. We should finish the chapter 3 handout, I think. We'll see. Yeah, and then we'll go. And next week we'll have some textbook problems and multiple choice questions for the exam. If you have not turned in the exam, I think it's due this Friday. I'm almost positive it's due this Friday, and so make sure you get it in. Well, I just want to say make sure. If you don't, if it's going to your grade to date is going to be published on Saturday. If you don't have it in, it's going to look really bad because there's a 0 in for your test score. But as long as you get it in, you get a grade. So don't don't think, oh, I didn't get it on time, so I can't turn it in, anything like that. But it'll be entered in your grade as of this Friday at midnight. Okay, let's go to chapter 2. Okay. Let's go to number 7. That's the last one. I just want to highlight something here. Now, this is a company that they did not dissolve. And the entire company is in this investment account. Okay. So the parent company did not dissolve the other corporation. They bought all of the Canary Corporation. So they bought all their shares. They did not dissolve the company. They're carrying it on the books as an investment. They're keeping track of that investment using the equity method. Now, if they own more than 50%, and in this case, they bought all of it. If they own more than 50%, they have to do what they call consolidated financial statements. So here's the thing. You're going to take the two financial statements for the two companies and kind of jam them together. More than that, but basically that's what's going to be. You're going to take, all what cash do they have, add to the cash you have. What accounts receivable they have, add to the accounts receivable you have. And what are the revenues and all that kind of stuff. But here's the problem. If you add that company onto the books, if you add all their assets, all their liabilities onto the books, you run into a problem that you're going to have that on the books twice. Because you have it on the books as an investment for the parent company, the entire company, the entire subsidiaries is an investment. And then if you add all their assets and all their liabilities, you're adding it, it's basically being on there twice. So we have what we call eliminating entries. We eliminate the investment account, but we take all their assets and all their liabilities and put them on the books, and the revenues and expenses and all that kind of stuff. We take those all and put them on the books as if we're one big giant company. So the consolidated financial statements are those companies that you own more than 50%, and you put them on the books as if it's one giant company. And you'll see this if you look at the financial statements for a large company, Ford. They're going to have financial statements for Ford Motor Company, and they're also going to have consolidated financial statements. And that's all those companies that they own over 50% will also be added onto all the stuff Ford has, and it'll be one big giant consolidated company. Okay. So coming down here. Now this is not dissolved, and we're making this as of the day we buy it. And here's the thing. So we got this investment on the books. This investment is the entire Bill company. So if we just take these two financial statements and squash them together, we're going to have a problem because it'll be counting Bill twice. Bill will be on the books as the investment, and Bill will be on the books for their cash, receivables, inventory, and all this stuff. You know, all this stuff, actually, it doesn't go down that far. All this stuff is the same as that. So what we're going to do is take this investment off and put this stuff on our books. All right, so let's see how that works. I'm going to do some of this stuff. Okay. All right, so Amy purchased Bill Company on cash. So these are all fair value. So these are the, I didn't leave very much room here. So identified assets at fair value are 1320. Bill Company will not be dissolved. No goodwill exists. We'll talk about this in a second. Cash price paid 9,600. And you can see that that is this, right? It's the 9,600 there. All right. So here's what we're going to do. Go up to the top here. I should put this down here further. So this is chapter 2, and this is right when we do the consolidation. I'm going to copy this down. So I'm just taking this is off of page 2. Page 2? Yeah. On page 2, I'm just going to copy these two down to the bottom. I should have done this before. Let's see here. Okay. I think I'll just put it down here. Okay. So I kind of show you how we're going to. So S, the stock and additional paid-in capital of the subsidiary are closed to the investment account. And this includes the retained earnings. So the entire equity section is going to be closed to the investment account. And then we're also going to close the excess assets. So we're going to do the first things first. Okay, so notice the entire equity section of the subsidiary is really not out there. There is no outstanding shares of stock, of common stock, additional paid-in capital, retained earnings. We own the entire thing. So what we're going to do is eliminate these from the investment account. So let me show you how we do this. So S. So this is the shareholders equity section. And we're going to take each of these and take them out of, you know what, I should do equal. Oh, no, I shouldn't do equal. I'm not, I'm not in Excel. What am I doing here? I don't know. All right, so the next one we do is in Excel. Okay, so let me just make these make those yellow. So we are going to take those out of our investment account. So I'm going to add all these up by hand because I'm an idiot. I don't have this in Excel. $81.60.
Yes.
You get it? Okay. Now we have one more thing we got to do. And it comes to these assets. And some of these assets, the fair values may be more, they also could be less than what they have on their books here. So these are the fair values. We come down here and these are the book values. So for instance, the cash, well, the cash is just gonna be worth whatever the cash is. Receivable is probably the same thing. Come to inventory. Their inventory, I'm gonna put it down here, is on the fair value of it. Oops. Is 4,000. I'm just putting it here for a temporary holding spot. So the fair value of their inventory is 4,080. So we're going to have to make it, we're going to have to make an adjustment for that. They have it on the books at 3840, so we're going to have to adjust for the additional amount. 4080 minus 240. And then we come to land. And the land is also worth more than they have it on their books. And by the way, this is kind of a common thing that we'll talk about in a minute here. So how much additional do we need? So 3360, they have the books at 2880.
480.
480, thank you. And buildings are the same way. Buildings are worth a little bit more. $720, I think. 80 minus 60 is 20, minus 20, yeah, I think it's something. Okay, so this would be also so what we're trying to do is bring these company book totals, we're trying to bring those up to the fair value that we actually paid. You know, this is what we actually paid for those. And so we're going to bring it up to what we actually paid for. And we have to take that out of the investment, whatever those add up to. $1440. Okay, so here's what we're going to do. We're going to add up all of the stuff here. Now you'll notice that the investment account is going to disappear. These two should add up exactly to the investment account. I think they do. So we're going to add up all their cash and their from both companies. Just keep going down the line here. 3360. The investment account should be 0, and it is if you take the 9,600. Now these are credits, so they're going to be subtracted as assets going down, and those will come out to 0. We got 40,320. Okay, we're doing the same thing down here. Now down here, let's do the first couple, then I want to talk about these other these amounts here. All right, just add those together. 4,560. Okay, now these accounts from the subsidiary from Bill Company. Notice that those are really, our shareholders really own all this. It's included in the equity section for the parent company, Amy Company. They have these amounts are included in there. These are all going to be credits over here. These are, oops, Alexa. Credits. So when we debit them, they're going to go away. So this whole equity section for bill is gonna go away. It's if we're subtracting the whole thing. The only thing that's gonna be left is the equity section for Amy Company. Amy Company owns the entire bill company, so that's the only thing that's gonna be left. Hopefully that comes out too. Same that we have above. Hey, it does. And so notice that only the parent company's equity section is left. When it comes to the equity section, only the parent company stuff is up. This is all gone. You can't see it. I tried to draw a line through it. You can't see it. But anyway, this is the only thing that's left. And so when it comes to the consolidated totals, well, that's kind of goofed up. Writer. Hey, it's still not working. Okay, so these totals here, this is the only thing that's going to be left on the financial statements, and you're not going to see bill at all. You know, this stuff will all be for the consolidated financial statements. It'll just look like this part over on the right. So consolidated total would be cash 3360, receivables 3600, and blah blah blah. All the rest of that you won't see. Once you make the consolidated financial statements, you're going to immediately reverse them because bill company is operating on its own. Bill company is operating as a regular company, and it's, you know, they're going to keep their books their way that they've been doing it, using their amounts. And it's not unusual to have assets that are undervalued. I think I may have talked about this. One of the real weaknesses of accounting is what we do with depreciation, because what we do with depreciation has nothing to do with what like economists would talk about as depreciation. Our depreciation is kind of wacky in that you can have something that's, for instance, you buy a building 30 years ago, you know, they paid whatever 200,000 for the building, and now it's worth, you know, 6 million. But they have it on the books at 200,000, and they're still depreciating. They're still making every year. They're knocking it down in value, which is kind of a, you know, you get kind of a ridiculous number. It's $200,000 or whatever for a building that's worth much more. So it's not unusual to have assets that are undervalued on the books, especially. And economists will tell you that it's the upkeep of the current assets is really the depreciation, the capital expenditures that are made for things like maintenance to keep something up and working and at the same capacity. But that's not what we do in accounting. We say, okay, it's going to last for 10 years, and we slice it up for 10 years. So you end up a lot of times with, especially things like assets that are actually going to be worth significantly more than what they have on their books. Okay, and we'll do this one too. Oh, this one we have to calculate the goodwill. I don't know. I didn't go get into that in the last one. Let's go back to this one. I want to show you the kind of what we do with this. So these are the identified assets. But what we have to do is subtract out the liabilities. Color to make those. So they have these liabilities and they tell us the liabilities on the books are at the same amount. So we have accounts payable for 1,200 and bonds payable for 3,120. Okay, so coming up here. We have identified assets of 13,920. We're going to subtract out accounts payable for 1,200. Because we owe 1,200. Then we're going to subtract out bonds payable. $3,120. Yeah. And so this will equal the value of what we purchased. So 13,920 minus these two will equal the value of what we bought, the identifiable assets of what we bought. And you'll see that that equals the 9,600 that we paid. So there was no goodwill. Everything was identified. We paid exactly what the identified assets were worth. Question on that? So here's the identified assets, here's the identified liabilities. So this is what the identified, the fair value of the identified assets are. And that's what we paid for them. So there was no goodwill. Okay, jumping down to this one. This one we are going to have goodwill. All right, so let's see how this one works. So this is the cash price that we paid. These are the fair value. Now we still have these accounts payable that we also have to pick up from this place. So accounts payable is 5,000 and 13,000. Okay, so we're going to take the identified assets. We're going to minus 5,000. Going to minus 13,000. Okay. And so this will tell us what the value is of the identified assets. Is that 40,000? So 58,000. 58,000 minus. Yeah, so it's 3,000. So this equals 40,000. So these are the identified assets. And identified assets. Okay, so we identified 40,000 of the assets. But we paid 42,400. So how much was the goodwill?
2,400.
Yep. The difference between those two. So, we paid this extra amount. What we pay for? Well, we're not stupid. We didn't just give them money for no reason. It was for the goodwill. The goodwill will be 2,400. Okay. Let's go back to this one. I'm going to copy these two down. So we're going to get rid of the shareholders equity section. And the additional assets. And take this investment off the books. Because we're going to pick up all of these individual accounts from the bill company. Okay. Let's take a look here. So Sadie, as I remember it, so we'll do the S's first. I think it was yellow. I think I did yellow last time. I just copy all those. I bet I can. Hey, look at that. See, I'm teaching you guys how to be lazy, just like me. All right, so we're gonna take it's off the books and $34. All right, and now we gotta go to the assets. Inventory. Fair value is 17,000. Land fair value. 14,000. Buildings are fair value 12,000. Okay, so we have to add 1,000 onto the inventory, 2,000 onto the land, and 3,000 onto the buildings. And there's one more asset.
Goodwill.
Yay, good. Yep, goodwill. We have to add that goodwill in.
2,400. Yep.
Yep, 2,400. And we got to take all of that off of our investment account. Was that 8,400? Is 8,400. So total, yeah, 42. Okay. Okay, so this one should be easier to do anyway. Nice, oops, nice normal numbers. Back 100 years ago, when I took the CPA exam, they didn't allow calculators, so yeah, I had to do it. On paper in your head. Oops. And it wasn't too bad though, because all the numbers were all nice and round. They'd always have numbers like this. They would be real easy. More 142, yeah, and then 20. Don't forget this one. The most it on an exam, if people miss one, it's almost always this. So it's if you forget that that's an asset, but yeah, it's gonna be on the books too. So if you ever don't balance, look at the goodwill. All right. Got 170. Yep. And coming down here. Oops. And then only. Only these will be left. Only the shareholders of Amy Company actually have any shares of Bill Company. It's already included in their equity section. So this entire equity section goes away for Bill. Let's see if that adds up. Yep. And so again, when you show these in the consolidated form, this is all you're going to see is the column on the right. Now, Amy Company and Bill Company, they may very well have their own financial statements they put out, but when they do the consolidated, you're just going to see that total amount on the right. Question on that? And again, these journal entries will be on the books for until you do the consolidated, and then you reverse them all back out. Because these two companies are really on their own. Oops. You know, Amy will be keeping their books the way that they're supposed to, and Bill Company will be keeping the books the way they're supposed to, and it'll just be business as usual. Yeah, this is purely an accounting thing that we do to consolidate them. Any question on that? Okay, well, that is the chapter 2 handout then. Let's save that. And that brings us to chapter 3 handout. Do you guys want to take a break, or do you want to push through a few more minutes? I'll tell you what, I'll go over the things that we're going to talk about in this one, then we'll maybe take a break after I go through this, and we'll start doing some of the problems. Okay, it's basically the same thing we just did with a little bit of a twist. All right. We still have the stock and we still have the excess assets. This is a consolidation subsequent to acquisition. So what this means is, the first one we did was just right when we buy the company, we did a consolidated financial statement. Right when we purchased it, what would it look like? This one says, okay, after a year, what would it look like? Now, notice a subsidiary is going to have income. They're going to pay dividends. They're going to have excess assets, most likely. And they're also going to have depreciation on those excess assets. Right? So this is all going to go on during the year. And so when we come back to jamming these statements together to eliminate that account, we have to eliminate those things. Because the income that we're going to show for this company is going to be included in the consolidated income. We're not going to have two different incomes. We're going to have the same income. So we have to reverse out all those entries that we made during the year using the equity method for that investment account. We have to reverse those out because we're going to pick up, as if it was one company, all the revenues, all the expenses, income, dividends, all that kind of stuff. Okay, so this is after a year. So we have all these additional things. So these are really what we're talking about. The additional things that happen throughout the year. How much dividends do they pay in the year? What income do they have during the year? What additional expenses for the excess assets they have year to year? So, these excess assets are going to be depreciated, or depending on what they are, I guess. But those are all going to go on during the year. Okay. Here's kind of a little bit of a refresher on the equity method. You remember that we have the investment income and amortization of the excess. Comprehensive income's in there. I never put into that. You could have it in there, I guess, but and same thing with the investment accounts. And again, all those with the exception of that one, basically. So the investment account, dividends, amortization, all that kind of stuff. So that's all going to be run through the investment account. You'll notice that these two are the same, amortization of the excess. Okay, in the textbook, this is kind of a strange one. I'm not sure why they did this in the book textbook. But if you look through the textbook, it might be kind of confusing sometimes, because they said that what happens if they didn't make any journal entries during the year? If no journal entries were made, which kind of doesn't make sense, because if they pay you a dividend, if you get cash if the subsidiary pays you cash, you can't just ignore that. It's gotta get deposited. We have a double entry system. It has to go into something. You can't just pick up, cash and not have, you can't have the debit and no credit. So what does it get credited to? Firstly, all the companies, if they're gonna have these as consolidations, they're gonna be using the equity method. It just makes more sense to do it that way. And it's the way companies really do account for their income, These are all the things that we do to get to our net income, and that we get to our retained earnings. Okay. So those are the three. So let's see what this looks like. Maybe let's go through this first one. We'll go through this first one, and then we'll take a break. Okay, so let's look at, one thing that you try to do whenever you look at a problem, try to get your arms around kind of what it's all about. Now notice that these are all on at the fair values. So these are all at fair value. Now, because they don't give the book value, they bring out to the side here the excess. So for instance, the book value of this land account must be 60,000 because it's the excess over book is 10,000. This one must have been what? 45,000, because the fair value is 65 and the excess is 20. No excesses on these. Okay. Bill company will not be dissolved. Liabilities and fair values equal to their book values. Book company's best account is using the equity method through 2019. Okay, and we're going to try to figure out what the goodwill would be. So here's kind of how this works out. So here's all the assets at fair value, but now we also have to take their liabilities. Blue. So that's what these are. So this is the net identifiable assets, the 290 minus, there should be a line underneath here. 290 minus 25,000 minus 65,000 should give us that. It must, right? Better check it. 290 minus that. Yeah, that's not good. Okay. So this is the identifiable fair value for the assets. Now the question is, what about goodwill? Is there anything that's not identified or unidentified? How would you figure it out? So here's the identified assets. I'll make that green. It's not bright enough. It'd be too dark. It's always the colors. This is the hardest part. Okay, so the net identified assets at fair value were 200,000. We paid 225. So what does that tell you? The goodwill must be
The difference between them.
Yep. So the goodwill here will be that. And goodwill is by definition an unidentified asset. It has to relate to how well the place is being operated. Okay. Tell you what, let's stop here. Stop here because it's gonna take a little while to put the rest of these in. So let's stop here. Let's say be back at what? Be back at 7:02. Oops. Okay. And then we'll fill in the rest of this down here. It actually, it looks intimidating, but it actually goes pretty quickly, especially since doing it in Excel is a little bit quicker. If you're not doing it in Excel, you can simply look at the numbers that we pull out in Excel. If you're doing it by hand. we're gonna have we're gonna be filling this in a second here. Down at the very bottom, I got a list of all of the things. I'm just gonna put it on the side here. This is a little more convenient. Okay, so what we're going to do, we're gonna go through the first one too, like we've been. This first one's gonna be a little bit different though. And I'll show you what I mean in a second here. So the first one's gonna be a little bit different. So the SNA, so let's just go ahead and do that first. All right. Only the common stock and additional paid in capital are gonna come off down here. I'll show you why in a second. Now, this ending retained earnings, that includes the income and the dividends. That includes these two. So we have to actually go up to the statement of retained earnings and take it off up here because the 81 is going to include the dividends and the income for the period. So when we take off the equity section, we're going to take it off at the beginning amount up here. Now, the entire 81 will come off, but it'll come off when we do the other entries. So that one's a little bit different than we had on the other sheet. Okay, so here's the investment account, 239. We have to take off let's see here. So we're taking off the 30,000, 75,000. Ignore this ending retained earnings. That's going to go to zero anyways. After we do these, the beginning and the dividends and the income, it'll go to zero. But we are going to take it out of the beginning retained earnings up here. So this is a retained earnings statement. Questions on that thing? Okay, now we're going to have to put the excess over book assets, so land and building, 10 and 20, land and building, 10 and 20. Color. Any questions on that so far? Okay, coming down here, dividends. Now, these dividends for the subsidiary, these are debits, so we're gonna get rid of them with a credit. And if you recall, remember dividends, we used to subtract out the investment. Well, now we're doing just the opposite. We're adding it back in because we're kind of undoing what we did before, basically. Okay, income. We're going to close out the income account. It's sort of like we're unmixing a cake. You know, we adjusted this account all throughout the year for all these things, and now we're undoing it because we're just going to put the revenues, expenses, assets, liabilities on the books and combine them all together. Okay. Now, additional expenses. Okay, additional expenses. We put these additional assets on the books. Now, the land we're not going to do anything with, land doesn't depreciate, but the buildings do. So how much of additional expenses are we going to have for the building? Hey, you guys are sleeping.
Can you say it again, please?
I'm sorry, what?
Can you say it again? Sorry.
Yeah. So we had this building on the books for 20,000. We had additional assets. Now a year's gone by.
Mm-hmm.
So how much additional depreciation are we going to have for that building that we had to add 20,000 to?
So we use the life and we calculate, is it like yearly 200? I mean, wait, 20,000?
20,000 is going to last for 10 years.
Yes. Okay, so do we
like
use for 1 year, right?
Yes. So it'll be 20,000.
But divided by 10 is going to be like 2,000.
Yeah. All right. Right. So this is, what is this thing, building? All right. So the building, 20,000 years. And so the depreciation would be 2,000.
Yep.
So we have to depreciate an extra 2,000. So we're gonna, and this depreciation expense, we're gonna put in. Oops, hey, turned off my capital. All right, expense for 2,000. We have to expense now. This bill again, yeah. So bill company, you know, they're expensing it based on 45,000, but we're expensing it based on whatever, 65,000. So we have additional expenses here. So this will be expense more. Now down here. You know, this is going to be part of our accumulated depreciation expense. Down here at the bottom, because it's going to reduce the building. You know, we're going to put it up, we're going to increase it immediately by 20,000, but then we used it for a year, so 1/10 of that is going to come off. All right, now hopefully all of this will work out. So we're going to do consolidated totals over here. Nice thing is we can do formulas for these. 750 plus. I'm gonna bold this. Maybe a little bigger too. I'm gonna put the rest of these in as negatives. Because cost of goods sold is what left the place, expenses, money going out. You don't have to do that, but as long as you rectify it at the bottom there. Okay, so we'll say minus. Oops. Okay. Amortization expense is 0. Now the investment in equity income, this will be a credit. You notice that we've debited it, so this will be 0. You don't really have to put that in, but. Now, if we did this right, we should get this same 79,000. This 79,000 should be exactly the same number. As over here. Hey. And you say, well, why? Well, because we actually have everything. You know, everything is actually included in this. You know, the 79,000, you know, it has everything from over here. By the way, why is there a difference between the income? Bill company shows income of 21,000. We show income of 19. Why is there a difference?
Based on the ownership percentage.
Actually, with the I think they own 100%. I think.
Oh.
But there is something that goes along with it, that, you know, that we had to do that they did, basically. You know, so they're showing 21,000. We're showing that they made 19,000. Why?
The depreciation.
Yep. Yeah, we picked up the 21,000, but then we said, okay, we got to knock it down by 2,000 because of this depreciation. So that's why we have 19,000. And, you know, they're showing 21,000 because they're not depreciating. You know, they're only depreciating whatever 45,000 of buildings. We're depreciating 65,000. Okay, coming down here, the only thing that's going to be left are the AV company retained earnings. The stock, the initial beginning retained earnings, I should say, are gone. The income is gone. It's included in the 79,000. The dividends are gone. And so the only thing that's gonna be left, it'll be exactly the same as. I do. I did. Okay, so. God, I did it again. I don't believe it. Okay. I know what I mean. Okay, 78,000, now the dividends are money being paid out. I'll fix this in a second. And so this should be. Okay. So you'll notice that. The statement of retained earnings is gonna be exactly the same as the parent. Okay, coming down here. Here, we're gonna add these together. Land is gonna be 100,000 plus 60,000 plus 10,000. And this one will be minus the 2,000, so I'm gonna put that in. No, that's not right. It's not picking up those. Did something wrong. Let me try this again. Okay. You know, I think I know what I did. I think I added and subtracted it. Is that one right? Yeah. Hey, I did something wrong. What did I do wrong? I did exactly what I told you guys was if you make a mistake, that is gonna be the one that's wrong. I didn't put the goodwill in with the assets. See that? We have goodwill of 25,000. I didn't put that in. I was demonstrating to you what not to do. Don't do this like me. I gotta change that. Oops. So this asset account. So everybody make this change. All right, now hopefully that'll work. Let's take a look. Okay, so. Plus 5,000. Okay. So don't forget to put this one in. Don't be like me. Make sure you put that one in. If you haven't already. Okay, same thing down here as we did before. And the only thing that's gonna be left from the equity section, though, is the parent company. All the rest of these are zero. Any questions on that? I know it's the first time we've seen it, so. The first time you saw me do an error on it, which kind of goes hand in hand with the first time you've seen it, but yeah. One thing you may be asking yourself is like, well, why is this? You know, understand that this is on the parents' company books, but we have this investment account. You know, why is this 769 and this is 859? Why aren't they the same? Right? I mean, you know, this number has the investment in, and so does this. Well, why is that? It comes from down here, actually. If we were to break out these liabilities separately, if we were to add those back in. $769 plus the 90 would be. Should be this $859. You know, notice when we put this in up here, we did it net of the liabilities. Well, we're not doing net of liabilities down here. We're separating out the liabilities, so we had them on the books. So this amount will by default be what we had plus the liabilities would be the total assets. We're going to subtract it away from those assets down here, you know, to come up with the balance. But and here's what you'd see for the consolidated financial statement. This would be the only thing you'd see. So Amy and Bill would have theirs separately, but you'd only see this if you looked at the consolidated. Question on that? I know it's a lot to take in, but it's let's do one more. Let's do one more just to prove we can. Oh, this one's gonna be a little more difficult. That's okay. We can do it. It's a little more difficult because I don't have some of the numbers in here. We're gonna have to calculate this, the fair value of net identifiable assets. We got to do that ourselves, but that's fine. Okay. So this is problem 3. So we bought this company for this. And this is what we got. We got the total assets at fair value. Now, along with those, we got these liabilities at fair value. And those are can be subtracted, those are money that we owe people. So this will give us our. Net identifiable assets. Okay. So we have our. Let me do something here. So we have our cash price paid. 320, no. 360. So we have goodwill of. Okay, what much more space do we need? Goodwill would be what, 40? Okay. So. Let's go through here. S. Together beginning retained earnings. Common stock. Next you go to assets. 16 and 32,000 for land and building, same as before. And what else?
The goodwill,
Yes, very good. So the goodwill, we have to add that on the books. Was it 40,000? Okay, dividends. Dividends are debit, so we're gonna credit those. So on Sadie, we're now up to it's investment income. And lastly, we have these additional expenses. Hey, it's a 10-year life, nice and easy. So we're gonna have additional expenses of
3,200.
3,200. Yep. And that will be the difference between our income, it should be anyways. Yeah, it is. And also down here, we gotta knock it off by 3,200. Take it off the value because a year's gone by, so. And you know, this will just keep going down for the next 10 years until it's gone. That's it. Okay. And we're taking out the entire income because it's already gonna be included in these totals here. And if we did it right, this should come out to, yep, that number. These over here should all just be the parent company numbers. 560 plus 104 minus 104. Let's see that. Had income 126. And that just comes from up here. I don't know who came up with the default color for these shape, I'm sure there's a way to change it, but it came up with really light blue. You can't see it. All right. So anyway, that, and then the dividends are subtracted. And this should come out to be the same as that. Yep, and it does. Oh, wait a minute. How to use that? Okay, down here. Plus any debits, minus any credits. All right, and again, the reason why we're getting rid of this investment account is that really this investment account is the same as the bill company. This bill company is this investment account. So if we didn't take this out, we'd be counting it twice. So that's why this is going to be 0. And down over here. And the only thing that's going to be left are the parent company. Totals. And if you wanted to see how we came up with those total assets. It should come out to be the same. Yep. Well, that was fun, wasn't it? If you guys want to get a screenshot of that, you can. That's pretty much the whole thing. By the way, this down here, this is the same as. Okay. Enough fun? You guys have enough fun for tonight? I think I have. So let's stop here and then we'll do these other two next class. Okay, and again, I think this Friday, let me check it. I'm not telling you something incorrect. Yeah, the chapter 1 exam is due this Friday. So see if you can get that in. If you have not, I know a number of you have already got it in, but if you have not gotten that in, maybe see if you can get it in by Monday. And we'll pick this up next week. Next week we'll do the other parts of this handout, and then we'll do a couple problems out of the book. Any questions? All right. Well, I will see you guys in a week's time.
All right, thank you so much.
Thanks, Professor. Have a good night.
Yeah,
Have a good night, Professor.
I will. Thank you.